11 points higher for the Nifty, as flat as it could get. It's the banking names, especially the PSU ones, that continue to lead the rally. Let's go across to our first guest on the show. Mr. Vidal is now with us, director with Buoyant Capital. He's with us. Vidal, thanks so much for taking out time for us. Could you first start by the market perspective? What is the sense that you get in terms of this year, how things have moved, and how this has, of course, been the emergence of pricing as far as India's P multiple goes versus rest of the world is concerned?
Sure. So maybe we'll talk on the macro outlook and then go to the earnings trajectory and valuations. So in terms of the macro outlook, right? April to June, the current account deficit was $24 billion. We have burned through almost $100 billion of forex this year. Short-term maturities are another $280 billion next year. So we will it will all get rolled over, but it's not a very comfortable position. Also within India, if you look at the deposit growth rate compared to credit growth, it is hit its lowest. So, and government borrowings are also very high. So maybe liquidity in the banking system, which has slipped into negative, we will see that, or we might see that the private sector gets crowded out. Call money is already over at 6%. So this might also force RBI to do a higher OMO. So on liquidity front, domestic liquidity, we think will be tightening. Also, high frequency indicator are sort of stalling. The freight, if you look at the freight transport, how much is going, the fast tag collection for the GST. And they are at a high level, but they're stalling. They are not growing. So it's not very alarming, but it's not very comfortable either. Now coming to earnings. The Nifty earnings, Nifty EPS for 2024, I think peaked at around 1,030. We are now down to below 1,000. So earnings are getting cut. Again, the same thing, not very comfortable. And valuations are at over 19 times. India, of course, compared to MSCI emerging market, has always been expensive. But we used to be 45-50% at premium. We are still at 90% plus premium. So compared to emerging markets, we are expensive, and when our growth is sort of, the earnings are getting cut. Lastly, CY22, with the current market where it is, this is the 7th year in a row we will have a positive close. It's happened only once before, never before. So if we have a positive year next year, it will be uncharted territory. Just because it's not happened, I'm not saying it will not happen again. But you can't have a very big upside when your starting PE is close to 19-20x.
Right, got the point. In terms of banking, we last 1.5 months has been about the banking sector, especially PSU. You think this all-out crowded trade about banking names can continue to do well?
Yeah, that can do well. See, we have seen that, especially in PSU name, when the cycle is favorable, they do 2-3 times, 200-300% returns on some of the names. We have seen that happen in the, when 2004-5, they had that big rally. We saw it that time. Even post GFC, you saw a big rally when the credit cycle improved. They're in a good credit cycle. Growth is still in single digits, but at least the incremental bad debt addition is reduced or close to zero in a lot of cases. Valuations, when they started this rally, most of them were at 0.3, 0.4 times book. They're probably at 0.6, 0.7. So, and they go closer to 1 time book is a time when, we should start getting careful. But you can still see this momentum continue there.
In terms of PSU names, are you fond of PSU or private now? Or with the rally, you believe where should one invest now?
So now incrementally, we are not buying PSU banks other than SBI. Among private, we think Kotak Bank will catch up on growth. Plus also there might be a near-term trigger of FTSE rebalance that happens. So that's where we are investing incremental capital.
Okay. So since IL&FS crisis, there has been an issue regarding NBFCs, maybe smaller banks. That's not something which people want to own. You think there is some risk on appetite left over there? I mean, if there is a risk on trade in banking, these names could re-rate more?
Smaller private sector banks, maybe yes. NBFCs seem to have a problem, right? If you were to divide them into gold financiers, banks are taking away their market share. Vehicle financiers, maybe they could rally, especially And we think CV cycle has just begun. CVs might have a good couple of years ahead. So CV financiers might do well. Again, mortgage, we think might be a problem. So you have to pick and choose between NBFCs. The space that we like there is the CV financiers.
Okay, CV Financer is the ones that you like. In terms of names like metal pack, steel, non-steel, you think the best is behind, or this time around it's changed because their debt profile has changed, and right now they're not picking up debt?
Good that you asked it. Yesterday was very counterintuitive because China sort of reopened or lifted many of the COVID restrictions, and you would have thought that oil rallies. Oil actually went down yesterday. So I think recession fears are overwhelming the sort of positive that one is seeing because of China sort of reopening. So metals, yes, they might not be as volatile they have been in the past because the debt is reduced. So the EBITDA, even if it goes down, the EV EBITDA might still be in a range. But in the near term, maybe it's more of recession fears, more of slowdown. So unlikely that we'll see a big upside on metals.
So would that count as a avoid?
Yeah, it's an avoid for us.
Right. L&T hit an all-time high today. We had Siemens, ABB that did well. Does that sector now qualify for looking ahead?
Siemens, ABB have always been expensive, but see, when this capex cycle starts, it's among the last ones to start. L&T especially might be interesting because of two reasons. One, they have a very strong balance sheet. They are probably the most diversified. So if you want to take a bet on infrastructure and you want a well diversified bet, you will still be with L&T. It's moved up a lot, but it's still lower than its historic multiples. If you were to sort of take off the valuation of its IT subsidiaries.
Right. So what is the take? I mean, should you be with larger ones? Should you be with smaller ones? In terms of how should you look at it? Because, when a smaller company wins a 1,000 crore order, it's much bigger than L&T winning a 5,000 crore order. How should you approach it?
So the way we are approaching is we have some bit of L&T, but we have taken a bet on a smaller company. We are invested in NCC. NCC on their base of 5,000-6,000 crores have a 42,000 crore order book, and so this year also it's like a 4-year order book visibility. This is now clean order book because they have taken off the orders which were slow moving or the AP issue that they had. So if you have a longer term money, maybe you should look more at the smaller stocks.
Right. Let's also just talk about, individual names that have seen a lot of supply coming in, especially on the e-commerce side. How would you look at those names? I mean, at certain price, all companies, all brands do have a value. You think some of these newly listed names or one-year-old names have started to reach a zone where one can buy them?
They probably were there a month back, maybe no longer. So we can see what happens is that the private equity selling that is there, that might continue for a while. So first round, second round of selling has got absorbed. But my fear is that you'll see multiple rounds of selling in this, what we call the new age companies. And there are companies where one might want to do their homework and be ready at a price. So for us, those stocks are PB FinTech and delivery. We don't own them, but these are the two companies we like. Some of the companies which are more onto e-commerce might see much more pressure and might have a longer cash burn issue. So if this sort of slow cycle or lower growth cycle stays for a couple of years, they might be under more pressure. So I would rather have companies which are fee-based, where path to profitability is nearer, 3, 4, 5 quarters down the line, and they don't have to make absolute profits even if they get to cash flow break even or EBITDA break even, but with growth in excess of 30%. Those would be the stocks one should look at. But in the very near term, I fear there will be multiple rounds of selling by private equity people.
Right. So supply will continue, and that's why one should just be careful.
Yes.
Right. IT last year, people were pricing in that, as if there is no tomorrow, and they are ready to pay anything. And large cap IT names, and I'm not talking about the Paytm, Zomato, I'm talking about the, Infosys, TCS, and various other names. How would you look into these names? 1 year of consolidation, earnings have not cut much. Do you believe that there are some places where valuations are looking good? I mean, They are high cash generating companies. Surely they give dividend. So there are a lot of benefits to look at it.
Definitely. So IT services sector has been one of the best performing sectors over maybe last 20 years or even longer. But mid caps, I still think within IT services are expensive. Within large cap, there are a couple of pockets where valuations are interesting. But there are two sort of headwinds. One, we feel that FY24, this companies might get into high single digit growth, something that they had in FY17 to FY19 because post COVID, the pop up came and that is now gradually coming down. So, on a high base, unlikely that the growth will be faster. Second, margins are unlikely to again surprise on the upside because last year companies had 2 or even 3 rounds of salary increases. And this is the first full year when the whole hit comes. Also, due to COVID, there were restrictions and people are not working from office. So the G&A spend, which are lower, are have started to come back. Travel spends are going up. So margins this year, companies have cut their margin guidance or are at least at the lower end. Next year also should be more of the same. I mean, be remaining where it is. So IT services, we are getting back to that 9-10% growth. Plus, you get 2-3% through dividends or buybacks. So you are again coming back to that normalized 12-13% compounding stocks. Within that, valuations, at least for Infosys and TCS, are expensive. They are more higher than the at least the 10-year averages. But one might want to look at Wipro or HCL Tech, where valuations are lower. Wipro, of course, also the expectations are much lower. So any positive surprise and Wipro might be interesting. HCL Tech is at maybe 3.84% dividend yield.
Right. So that's what you're looking at in terms of those names. Recently there has been a buzz regarding fertilizer sector, some other sectors, which probably you would have not looked earlier. But do you think the regulatory changes across certain small sectors do manage to take a look? For example, fertilizer, for example, roads. Are these sectors where you're looking at where over the last 5, 7 years, 10 years, there have been a lot of regulatory changes?
So lots of sectors, right? As you mentioned, fertilizers, roads, even more real estate, right? Because of RERA, the sector has changed a lot. So all these three sectors were uninvestable maybe in 2010 to 2013-14 period. They suddenly look interesting. Valuations have caught up, but there is consolidation. The number of players are reducing. The large are becoming larger, or even the mid-sized companies are becoming scale companies. So fertilizers, not as much, but within roads, I mentioned NCC is interesting. And within real estate, some of the Bangalore players are interesting because real estate is a micro market sort of play. You don't have companies which are multi-cities, or they might be small in the other cities other than their dominant city. So there we think Bangalore is a good market to be invested in.
All right, so thank you so much for taking our time for us. Good to get perspective from you.
Thank you.
Let's now go across.